Hello, class. Welcome to our first PowerPoint slide presentation in terms of narration here and description from the instructor. We appreciate you joining in and participating in this way. So we'll go over this some slides that go over Chapter 1, highlighting some things that I think are most important and might be most helpful. All right, so just an introduction. We're talking about simply income tax in this tax. So there's a whole range of types of taxes, sales taxes, property taxes, but we are focused on income tax and even more specifically, the federal income tax. So while I may make some reference to state income taxes and maybe even some specifics about Pennsylvania, since that's where HAC is located, that's just extra information. The real focus is on how we handle the federal income tax. So in the history of our country, there was no income tax prior to 1861. Went away. All right, came back in 1894. The Supreme Court said, no, this violates the Constitution. Okay, the Constitution has a clause in that basically says you can't, that people interpreted it as not being able to tax based on income. So we went through the process of amending the Constitution. 16th Amendment passed in 1913, and that became the first income tax. The income tax in, well, you might say it's a little bit structured like today, but it started out very, very simple. With very few deductions and only at a very low rate, and only involved people with more than average income. So most people didn't have to even worry about it. Today we have a process of filing electronically. 160 million households, if you will, file individual income tax returns, and that is also our focus, is individual income tax. We will spend a short while talking about income taxes as it applies to corporations, but just a single chapter. And in 2023, that's a lot of different situations, a lot of different individuals, and so there's a necessity that there be complexity to deal with all of the different scenarios. The amount of tax returns that were filed electronically continues to grow. There's a lot of incentive to do that. In fact, a tax preparer actually who filed more than 50 returns can't not file them electronically without a lengthy explanation. There are still occasional situations that require a paper return depending on your software, but it's rare today that you cannot file electronically, and it's just everything goes so much more smoothly with that. That brings in for the government over $2 trillion of income. There's kind of a breakdown of how that works in the by income in your textbook. All right, if you want to look at that based on data, and you can pull up IRS on the IRS website data about tax collections based on various levels of income and that sort of thing. The aggregate tax data. See how many people took this deduction, what the average taxable income, all kinds of different statistics of income. It's always, though, a year or two old, like he says here, about 2022. So they don't have data for 2025 yet because we're here in 2026. So 2024 is still they haven't released, for instance, the statistics of income on that. So as we dig into what we want to learn, income taxes, as it states, you figure out your income and then you calculate the amount of tax you owe based on that. So the amount of income is your tax base, and the rate of tax is what you multiply it by. All right. Maybe multiple rates on multiple bases. All right. That's how our tax in the United States works at the federal level. We have what's called a progressive tax structure. Tax rate increases as the tax base increases. So the more income you have, the higher rate of tax you pay. And it's not like change every dollar. It's kind of chunks of income. Okay. So that ours is an example of a progressive income tax system. What that means is very seldom can you take just the income and multiply it by a single tax rate to figure out what your tax liability is, okay? And we'll need to remember that when we get into homework problems and such, where it might seem like we can just multiply, but we're probably going to have to look at multiple tax rates because of our structure being progressive, different tax rates. If you have a single tax rate that applies to everyone regardless of income, that's what's referred to as a proportional tax structure. In Pennsylvania, for those of you who live in Pennsylvania, we have a proportional tax structure for our income tax in Pennsylvania. It is the same rate, 3.07%, regardless of income. Okay. Our sales tax, okay, is also proportional. It's the same, okay, regardless of the item you buy that's taxed at the sales tax. Whether it's a large one or a small one, it's the same rate. Okay, so that's a proportional tax structure. And regressive tax structure is where the tax rate actually decreases as the tax base increases. The Social Security tax system, in the sense that you pay Social Security taxes on up to an amount of income, and then it goes away. You don't have to pay any more. On the other hand, Social Security system is based on your retirement income is based on your earnings, and it only considers up to a certain point. So there's a trade-off there. Most of the time, regressive tax structures are not a good thing, or not. We generally don't see those happening. All right. There's some economic reasons why a progressive tax structure is preferred. It seems more fair to have those who have more means or have greater income to pay a higher percentage. So, average tax rate, a couple of other terms, versus the marginal tax rate. Average tax rate is simply take the total tax paid or owed, divide by your total income or your taxable income. After we'll get to the formula here in a minute, is their average tax rate. All right. The marginal tax rate is the rate of tax we paid on the next dollar of income. Always need to determine this with reference to the tax rate schedule, which is found in Appendix F. It shows the tax bracket. You'll hear you've heard the term tax bracket, and what that means, and I'll show you it on this next slide. This is the tax brackets. So we have in the United States federal tax system. We have 7 tax brackets. So income, okay, is taxed based on your tax bracket. So focusing on the single column, if your income is between 0 and 11,925, your tax is calculated at 10% of that income. If your income is between 11,925 and 48,475 for the year, okay, you pay 10% on the first 11,925 and 12% on the amount between over 11,925 but still under 48,45. Goes down the bracket, 22%. Okay, if your income, let's say, is $50,000, you would pay 10% of the first 11,925, 12% of the amount between 11 and 48, and 22 on the amount over 48. So you can see why someone is worried about bumping into the next tax bracket. So if your income is 48,475, okay, then the highest amount of tax you have to pay rate is 12%. But as soon as you get bumped over 48,475, any additional income, okay, is going to cost you 22%, meaning you only get to keep 78%. You got to keep 88% of it if it's below that, but after you go over that. Now, that doesn't mean the income is bad or anything. It just means that as you get bumped to the next tax bracket, your percentage on the next dollar of income, and that's what we mean by marginal tax rate. What are you going to pay if you make a little extra money? Because that's how businesses and people make decisions, all right, is on the marginal rate. What is it going to cost me if I make one more dollar of income? Or what is it going to save me if I find another dollar of deduction? Is the other way to think about it. So for a married couple, on their $96,951 dollar of income, so back to our tax brackets, going over to the second column, married filing jointly, all right, then if your income is over 96,950, which it was in our example 96,951, that $1 of income over the 96,950 is taxed at 22%, while all the rest is either taxed at 12% or 10%. So even if your income is at 752,000, you pay part of your income, the tax on part of your income at 10%, 12%, 22%, 24%, 32%, 35%. You don't pay 37% on all of it. You still have that, and that's why you can't just, unless your income is in the first tax bracket, you can't just take your income and multiply it by a single percentage. You've got to use a formula. You've got to use multiple tax rates in order to calculate that one way or the other. So here is the income tax formula. And this is going to stay constant. We're going to add complexity to each step, but the steps are not going to change. Okay? You're still going to calculate your income. You're going to subtract from it your permitted deductions. And we're going to keep those very simple at first and keep adding to that complexity and get taxable income. Then you apply the tax rate, and it could be multiple tax rates, right? Like we just looked at with the tax brackets, to calculate your tax liability. From that, you're going to subtract any tax payments and tax credits. We're not going to get into a lot of detail on tax credits until Chapter 9, but we'll throw a couple at us just to get the idea of how it works. Tax credits literally reduce the amount of tax you pay. Deductions subtract your taxable income, which then are multiplied by the tax rates and can lower your tax liability, but they don't do it dollar for dollar. So for instance, if you have a deduction and you are in the 22% tax bracket of $1,000, you're going to save $220. But if you get a tax credit of $1,000, you're going to save $1,000 because that's going to reduce how much your tax liability by the whole $1,000, not just the percentage that you would have paid in income taxes. And then we compare how much you paid or the tax credits you are entitled to your tax liability to see if you get a refund or you have to pay in. So tax return is just simply a reconciliation of what you did for the year, compared, and records you kept, compared what you paid in to what you actually owe. The concept, if you're going to get money back, that's a refund, not a tax return. A tax return is the physical or electronic filing that you make. All right? So just to check ourselves, marginal tax rate is the rate of tax imposed on the next dollar. Yes, that's true. average is the total tax divided by the income. Okay, marginal tax rate for married couple, just we're right at the same area as we were talking in our example slides earlier, in the 22% tax bracket. But you've got to look at those tax brackets, either in Appendix F or on the slide that I gave you, and see where you are, and that will give you your marginal tax rate. So when you do your homework, that's how you're going to answer this kind of question. Okay. So annually, everyone, okay, that has a certain amount of income, and there are exceptions, and we won't go into a lot of those, but everybody with income needs to file a Form 1040. All right, there's an example in your textbook. There's been some changes for 2025. It's gotten a little more complicated with some changes in the law. And then only certain things are actually right there on the 1040. And there's a page 1 and a page 2. Okay, so make sure you see them, you work with all of them. And then there are schedules 1 through 3. Some people won't need any of those. If it's a very simple situation, they won't need the schedules. And others will need all of them. And some will only need 1 or 2 of them. And there's a new one, of course, and they didn't want to mess up the numbering, I guess. So the new schedule for 2025 is Schedule 1A. Okay? So the promise of no tax on tips and overtime is handled on Schedule 1A. All of these schedules, though, calculate kind of like a total, if you will, that goes to the 1040. So the detail or the behind the scenes or the extra calculations are on the schedules. The number comes over onto the 1040. These are all just fitting in to our basic income tax schedule, okay? So, or the formula. So if you look at the 1040, and basically the whole first page is the income part, calculation of income, just listed of it. And then there's just at the very bottom, there's kind of a reference to some deductions, okay? And a reference to a schedule, which is where those deductions are totaled up or calculated, the detail. And you end page 1 with AGI, which we'll talk a little bit more about in a couple chapters. And then on the backside, okay, you're going to have some other permitted deductions before you get taxable income on line 15. Okay, on the back side. So, some things that you should note, okay, that kind of get highlighted, you might say. W-2 income from your wages, where you work. Typically, you get what's called an information return, W-2. From your employer, it shows how much you earn, how much they took out, all that good stuff. That information is going to go in box 1. Okay, the new deduction we talked about will cover more in chapter 4. Goes on a Schedule 1A and then comes over to the 1040. Interest income is listed. Will come from your bank or other financial institution that's paying you interest, and is reported to you on a 1099 INT, which makes sense. INT for interest to go on your return. You also can get 1099s. The dividends, DIV, you get other documents from the government, like if you had unemployment compensation, 1099G. There's a whole lot of these information returns that come to you based on somebody who has given you income in some form or another. For now, the only permitted deduction we are going to talk about in Chapter 1, keeping everything very simple, is the standard deduction. We will get to itemized deductions in Chapter 5, but that's the only standard permitted deduction that we're going to focus on in Chapter 1, and that is $15,000 for single and $30,000 for married. We'll talk more about the filing status and different filing statuses in Chapter 2 as we expand make our tax equation a little more complicated. But for now, we'll just have the two. It's either $15,000 if you're single at the end of the year, $30,000 if you're married at the end of the year. And then you have your taxable income, like it says on line 15. Now that you have your taxable income, how do you calculate your income tax? Well, the IRS realizes that calculating the tax is kind of complicated given that we have these tax brackets. It's not just a matter of multiplying by a percentage. And so they have created a tax table. It's in Appendix D. You can find it on the instructions to 1040. You can find it lots of different places. Make sure that you're looking at the current year tax table. The year we're going to use is 2025. Right, and that is up to $100,000. The official way you're supposed to figure out your tax is to use the tax table. All right, and look it up based on your income. All you need to know is your taxable income and your filing status. Again, single, married. Okay, to look up how much it is. And that's how much your tax liability is. If you're over $100,000, tax tables aren't available. You have to use what's called the tax rate schedule. That's in Appendix F. Looks very much like those tax brackets. It gives you a shortcut formula for calculating your tax at various tax brackets. Making it a little easier, but certainly not as easy as looking it up on the tax table. It takes some calculation. Make sure that you do that with the proper parentheses and such as you calculate that. Now, if you were to use the tax rate schedules on income under $100,000, which technically is not allowed for your actual return, you will get a slightly different answer than if you look it up in the tax tables, because the tax rate schedules are going to be exact. The tax tables, for simplicity's sake, does not give a tax liability for every single income amount. It give it for a range. So at the bottom of the range, you're paying just a little bit more than you should. And at the top of the range, you're paying just a little bit less. And if you're right in the middle, then you're paying exactly what you would get, the same as if you calculated it using Appendix F. So you'll get a chance to practice and see that difference in your homework. So review: taxpayers with taxable income under $100,000 must use the tax tables, and that is true. Okay, that's the official tax liability. Again, if you did it using the tax rate schedules, you would be off a little bit. I can't imagine IRS ever sending you a notice based on the $2 or $3 that would be different if you didn't use the tax tables. But according to the rules, you should use the tax tables. Okay, practice a little bit. Look at the tax liability of married couple in your tax tables. In your textbook, go to the income column, married income, $91,262, which is going to be in between two levels of income that are given, and you'll find that your tax is tax liability is $10,476. Okay, not a particular percentage of that income, but a combination of the 10%, 12%, 22% tax brackets. If you use the tax rate schedule, notice you'll get a little different, and they took it to the very penny just to show you that it is more exact using the tax rate schedule, but it's not official. So it's different by $1.56 or $2, depending on how you on your rounding. So most people do not, and you should not, and the rule is you're not supposed to wait until you file your tax return to pay all your taxes. Most of your income tax, if you're an employee, is going to be withheld by your employer and reported to you on your W-2. So 2 boxes you pay the most attention to: your income and how much you paid in taxes, for at least for our purposes now. Okay, all the rest of the information is important, and we will refer to it in a little later in later chapters. But right now, the wages and how much you take out. So that means you're paying all through the year in according to your liability. So at your tax return is really a comparison to what you end up of the year, because as you're doing that, you don't know for sure what your income is going to be for the year. You make an estimate, and that's how you pay your taxes, but you're along the way. But at the end of the year, you know for sure how much income you had, and so you can calculate it fairly exactly how much tax you should have paid. And the tax return is simply going to compare what you should have paid to what you did pay, and you're going to have to make up the difference one way or the other. You're either going to get something back because you paid too much, or you're going to have to pay more with your tax return. Okay. Low-income taxpayers may be eligible for earned income credits. One of those credits we talked about far more in detail in Chapter 9. It's a fairly complicated calculation of how much that credit is, but that's going to reduce, will be counted against your tax liability when your tax return. And so you may get a refund even though what you paid in was what probably should have been paid in, but it wouldn't have considered your earned income credit. And so therefore that credit may come back to you in the form of a refund. So it's basically a settle up, file a tax return, we either owe or receive a refund. We do not pay all of our tax liability when we file a return. Okay, we compare what our tax liability is in calculation in our tax formula with what was withheld. File a tax return, we're going to get a refund because we paid more, or employer withheld more than Brett's tax liability is calculated using his year-end income. Okay, earned income credit, or any credit really, is going to decrease the amount of tax liability. That's the whole point of a tax credit. All right. It will never increase a tax liability. Sometimes it won't decrease it because there's some limits on it, and we'll get into that later. But it will never increase. So this last little bit, we're going to talk about what we call tax authority. We're going to practice this a few times through the next few weeks as we do some what we call tax research. That's what our discussion boards are going to focus on. And it's just to get you an idea that you can go and find out what the rules are directly from the source. These are what we call primary tax authority. These are those who have been given authority to actually make the tax law. Our textbook publisher, other people, ChatGPT, all of those folks, okay, unless they are going to the primary tax authority, could be giving you just their opinion of what is true. If you are ever in a dispute with the IRS and you use other people's opinion as to proving your case, you will not be listened to, you might say. They are not going to put any weight on that other people's opinion. You're going to need to go to the primary tax authority, Okay, you may get help understanding what that says, but you need to be able to find the primary tax authority and point to it and say, this is why we did what we did, is because this source said so. Okay, and that's why we're going to practice it, and we're going to practice citing those sources, finding those sources a little bit, just some basics, nothing super complicated. But there are three sources of this primary tax authority. Statutory sources, that's the actual law. That's Congress. That's anything Congress has involved in. Administrative sources, that sources the IRS under the Treasury Department, who have been delegated the ability to administer the tax law. And then when we have a dispute about what things mean, they go to court. And so we have judges or courts who rule on things, and those become a primary source. Okay, and like most legal stuff, it's a little hard to read judicial sources and even administrative sources. Sometimes even the statutory sources can be hard to follow, and you have to be careful in our reading of them. Most people can't read it once and figure it out. It takes multiple times because there's exceptions and rules to the exceptions and things like that. But we want to practice a little bit of finding these so that if we're put in a position of having to defend a decision about how we dealt with things on a tax return, we could do so and sound like we know what we're talking about because we cite primary tax authority, not just what we read in the textbook. So, statutory comes from Constitution and is referred to as the Internal Revenue Code. Okay, when a law is passed by Congress that has to do anything to do with, well, any laws, they're given a number, public law, and that refers to the Congress that passed it and the number of the law passed. Okay, and often we give silly and sometimes not even accurate descriptions instead of those numbers, but that's the official way that they're filed. But you might, the most recent one, the Big Beautiful Bill, BBBA, or whatever they refer to it as. It had a public law for the Congress and the number of the in that session officially. Okay, so that's one reference to it, but that's hard to work with. Okay, so what happens is those public laws update the Internal Revenue Code, the IRC. All of the laws of the United States are organized into, you might say the code. Title 26, and there's a whole bunch of titles. 26 is the Internal Revenue Code. And for us, given our focus for this class, we're only looking at subtitle A, which has to do with income taxes, because Title 26 deals with all kinds of other taxes the United States collects. But we're only looking at subtitle A. So when you reference the Internal Revenue Code, it is always, and we're talking about taxes, and in this class, and any type of reference in the professional world, Title 26 and Subtitle A is assumed if we're talking about taxes. From Subtitle A, it is organized by section number, by topic. And the section numbers, of course, are in order, 1 through, 1,000, 1,100 or something. Okay, and that has, each section has kind of a topic, which of course makes it far easier to utilize than just laws. So when they pass the Big Beautiful Bill or whatever the public law is, it amends the Internal Revenue Code. So each section that is affected, each change, you go into that section, or some poor schmo has to go in and update that section with the new language. often when you research this and you find the section, somewhere down at the bottom will be the superseded section, okay, what it was before it got changed. And that's sometimes helpful. If they take something completely out and put a new one in, they'll put it down at the bottom for a while. Sometimes it's nice to see what, they'll highlight the changes, okay. Section numbers, still sections can be quite large, and so we break it down further to subsections, which are typically in small letters and parentheses, and paragraphs, which are large numbers in parentheses, and then they can have small numbers. So you see that subtitles are large letters, but we're only worried about A, so we don't need to worry about putting that in our reference. So if we're referencing the section of the Internal Revenue Code, we can say section, give it a number, and say the number. And then if we want to be more specific, which we usually do, give a subsection and even a paragraph. Okay? And with those parentheses, that tells us. And sometimes you have subparagraphs again with little numbers. When Congress is passing laws, they have a lot of hearings in the committee reports. And those can sometimes give us insight as to what Congress meant by the law. Because sometimes it's not detailed enough to be able to know how to apply it in real life. So we go back to the reports. Those are found in the cumulative bulletin. So the IRS has a cumulative bulletin. It's published on a weekly basis, and they put it all together at the end of the year, things like that. Okay, so there's a weekly Internal Revenue Bulletin, and it will have what's called committee reports, usually the House Ways and Means Committee, where perhaps you get by reading it. Now, I would say that has become less useful is because now they use those times to just grandstand rather than actually explain what their intent. But sometimes you'll get an intent of Congress, because when it comes time to enforce the rules, sometimes we want to look at the intent of Congress. And even though they may not say it explicitly in the law, there may be an clue that that's what they meant to have happen when you go back to the committee reports. So IRS, or the Treasury Department, which supervises the IRS amongst other folks, has been given authority to administer the tax law. So they do the things listed as we see on this slide. They provide regulations. Regulations are explanations of the Internal Revenue Code. So when your regulation, you reference a regulation, it's going to point to a section of the code. There's a separate place for the Treasury regulations, you have the Code of the United States, which we referenced earlier, and then they have an even huger register of federal regulations governing all kinds of things, well beyond just income taxes, but that's our focus. So that the regulation will say, this is clarifying a particular section, okay? And it will identify whether it's a temporary regulation or various types of regulations. We won't worry too much about the different types. We'll just count them all kind of the same. They provide revenue rulings, which is kind of an explanation of things that they get a lot of questions on. Revenue procedures are things that change every year, or they have to anticipate, we'll see things like the mileage deduction that gets adjusted for inflation. All of the tax brackets get published as a revenue procedure, the new ones each year because they get adjusted for inflation. Private letter rulings are for individual taxpayers' questions. We'll do some little research using private letter rulings later in the class. They send out they have notices when this is usually when things have been appealed up to the top part of the IRS and they feel like they need to clarify something that was unclear, okay, in earlier approaches. When we use these as sources, we want to use the citation way as shown in your textbook. And there's examples for each one of these and what the citation should look like. And that's what we want to try to do. That's the professional way of saying this is something that came from a primary source. Then there's the courts. Okay, when we have a dispute, usually between the taxpayer and the IRS, almost always, most of the time, all the cases we're going to look at are going to go to, we're going to use the tax court because that's probably 90% of the tax disputes. There's a specific court that have judges that have background in taxes. Okay, so these are not the same courts that you would have go for a DUI or other things like that. Tax courts are only deal with tax issues. Often it's much easier to deal with it there because the expertise of those involved. You don't have to, deal with a judge that doesn't know the tax law, that sort of thing. And so that's where most of the decisions happen. It's also a situation where the taxpayer has a dispute. They don't have to pay the tax to go to tax court. If they disagree with what the IRS says they owe, they can take it to the tax court, appeal to the tax court without paying it. The other two, the district court and court of federal claims, will accept tax cases, but only if you pay the tax first and then sue the IRS in court for a refund based on your dispute on how they should apply it. You can't file until you've paid. So that's a little more expensive. That's why very few tax cases end up in those other courts. Only where you have a very specific, think that court will give you the outcome you want. But usually you're best off in tax court. And there's a couple different levels of tax court cases. The ones that are under $50,000, you kind of use an expedited process. It's very informal. Okay, over $50,000, you get a little more formal. You start having, follow rules of procedure and calling witnesses and things like that. You probably don't want to represent yourself in some of those higher ones. You can on any tax court case. And there's different types of decisions based on how prevalent the issue is. The court might issue a memo decision, which is kind of limited, or a regular decision, which basically says, we think this is a big enough deal that we should give you a regular decision. When we cite these cases that, when we point to these as primary source, we say this is what we're doing. We should include the citation should include the court. Okay, so we know where to find it again. If somebody else wants to look it up and see if they interpret it the same way as we did. The type of decision, if it's a memo or regular or whatever, a year and number, and typically, most of the time, the party's name who was originally part of it. Back years and years ago, the people would file these cases and sue the commissioner of the IRS by name. And it was very confusing back in the, because the commissioner of IRS would change. And so sometimes it would be this name, sometimes it would be that name. Now we just assume it's the IRS on one side, and all we know is the other party's name. So that's the only one we cite. We don't, officially, there's always two sides to the court case. but we're only going to use in our citation the name of the individual who is bringing the case, not the IRS, or it says commissioner is the short term for the IRS. Tax court and district courts rulings can be appealed to the Court of Appeals. These are appeals courts across the United States based on geography. There's 9 circuits of appeals. You base it on where you live. You don't get a choice. Okay. You appeal your case. And by the way, tax court is held all over the country. There's various tax court locations. But they're all referred to the same as a tax court. And we can appeal, meaning we don't think the result happened the way it should. I think there was an error by the tax court, and so we want to appeal and get another ruling. They typically are not going to get more information. They are simply going to look at the decision and to say, tax court, based on the information they had, made a correct decision or an incorrect decision. Okay? They may overrule it. They may send it back to the tax court to say, no, reconsider this, consider this thing a little bit more, that sort of thing. But they do not bring additional witnesses and all that sort of thing at the appeals court. It can go all the way to the Supreme Court. You can appeal to the Supreme Court, but the Supreme Court is the one place where the court itself decides whether or not they're going to accept a case. Appeals courts don't get to decide that. If you appeal and willing to file the paperwork and everything, they will look at it. Okay? The Supreme Court picks and chooses, and so it's only going to look at cases it thinks are a big enough deal to justify their time, because they only have so many cases they can take in a year and consider. And so they are going to pick and choose those that are a big deal. Usually in tax cases, it is a situation where 2 appeals courts have come to a different decision. And then the Supreme Court will say, okay, we need to settle this because taxpayers are getting different opinions depending on where they live, and that shouldn't be the case. So, Supreme Court will step in and say, no, this is what should happen. Again, they're not going to call witnesses. They're not going to look at documents. They're going to look at the reasoning. And they're going to say, oh, I think your reasoning is wrong. I want you to relook at this. I'm going to send it back. And you guys reconsider it. They may split the hair and say, we've got to split the difference between these 2 situations. Or they may say, no, we think the reasoning of one appeal court is more in line with the law than this other one. Okay? So, committees charged with considering tax legislation, House Ways and Means Committee. On the Senate side, it's the Finance Committee, by the way. Okay? Statutory authority, Internal Revenue Code. All right. They have to be law from passing both houses of Congress. Administrative tax authority never takes precedence over statutory. It's always secondary. So you always are in better case if you're making your case from the tax law than you are from any administrative authority. But and it's successfully, people challenge IRS regulations and say, no, that regulation is not in keeping with the actual tax law. And sometimes they go to court with that argument, and sometimes they win. Okay. And revenue receivers are applicable only to the taxpayers issued. No, that's only private letter rulings were only applicable technically to the individual they were given to. Revenue procedures are for everyone. Okay, and regulations are the most authoritative of the tax authorities from the IRS. That's the highest, the best, if you will. Supreme Court does accept appeals of tax cases occasionally Not very often, maybe one a year, probably not even that. But it does. But remember, it gets to choose. Okay, it can. There are lots of things if you disagree with the IRS. Okay, within the IRS, you can ask for a supervisor. You can take it to appeals. If that still isn't the case, then you can go to tax court and then to the appeals court, and very seldom, but maybe possibility of going to the Supreme Court. If you don't want to pay your taxes first, you only have one way through the courts, and that's the tax court. Otherwise, you have to pay your tax and sue for a refund. Now, our last topic here is Circular 230, and this is kind of the rules the IRS has put out. Okay, that and it's going to be what we're going to do our research in this for this first week. It applies to anyone who's paid for preparing tax returns or providing tax advice, or as we call it, practicing before the IRS, meaning the person got audited or something challenged on their return, and they would like someone to represent them, which is a good idea, not required, but a good idea to have someone who understands the process to be able to represent you before the IRS. Those people who do that, okay, those that are paid to do that, have certain responsibilities, and those are outlined in Circular 230. This is kind of the rules. Some you might call it ethics, what expected, and you violate them, and the IRS can basically say, you can't do this anymore. You can't do this for money. You can't prepare others' tax returns. They can't tell you can't prepare your own tax return, but they can tell you that you can't prepare others' tax returns. If you continue to do so, then the penalties can go up. Okay, but the first thing is basically say you're in violation of these rules, and therefore we're not going to recognize you if you come and try to represent somebody. We're just gonna I won't say they will hang up on you, but they'll basically just say, sorry, but we can't work with you. Okay, you haven't been willing to follow the rules. So if it gets really bad, okay, so there's fines. Very seldom is there a criminal penalty, but fines, which are civil penalties, are not that unusual. Okay, these are fairly complex, and the sections of the code that tell about the rules. I mean, the penalties if you violate them are laid out in those two sections you see there. Okay, those have all been upped recently. Okay, to make it more expensive to be involved in, especially if you are aiding people in filing things that are incorrect. And if you know that or have been negligent in trying to figure it out, that can be quite painful if they catch you doing that. I like to tell people nobody goes to jail for taxes unless they willingly participate in something they knew to be false. And then you're in trouble. Mistakes, you can end up paying penalties, having to cough up extra money. But if it was a mistake, meaning you just didn't know what and applied the rules incorrectly, before they go after you for a criminal case, they have to kind of prove fraud, and that's the intent to deceive. But if that's the case, and especially if you help others by saying, "Oh, I can make it so you don't have to owe any taxes," and that that's not according to the rules, then the penalties can be stiff and severe, and people do end up in jail for that kind of thing. To keep track of who's doing who's preparing taxes, you get a PTIN. I just renewed mine for 2026. And so that I put on every return I prepare. Okay. So the IRS can track who is causing trouble, if you will. So I want to make sure that my PTIN is never seen as a trouble problem. Okay. If you're not a CPA, you have to, you want to be what's called an enrolled agent. Okay. And you're not a CPA or an attorney, you have to get some continuing education. You have to pass an exam to become a enrolled agent, which allows you to practice before the IRS. All right. Some things in Circular 230 that you must do as a preparer. Sign. Got to put your name on it. You got to take responsibility. Provide a copy to clients. Those can be done electronically now. Give the records back to your clients. You cannot keep their stuff. Okay, that is not kosher. That's not a way to get them to pay you or anything like that. That's not ethical way to get them to pay you, is to hold their stuff until you can not file a return, but you cannot keep their records. Okay, you have to do diligence. You have to figure things out. Okay. Disclose tax positions that are questionable, but frivolous means you really don't think there's any chance of it working. You're just going to file it that way and hope that nobody notices. Okay? But when disclosure, it doesn't get you out of it if it's a really dumb idea, but if it's questionable and you disclose it and you find out it's wrong later, the penalties and such are much less than if you didn't. If you just look like you were trying to skate by without anybody noticing. Okay? If you make errors, and they do, everybody does, you need to notify your clients as soon as possible. Okay? Provide any information that is requested by the IRS. You really don't have attorney-client privilege. You kind of have to cough up. Now, there are certain things that have been ruled you can leave out, but it's pretty narrow for us to prepare taxes. Okay? And, of course, if the client makes an error, you want to let them know so that they can correct it. Okay? Things you can't do, okay? Take position unless it is realistic possibility of being sustained. I mean, you've looked up the rules and you really think that it could work. And there's at least 1 in 3 chance that it will, if you took it to court, that they would decide that. Certain things you cannot charge a contingent fee. A contingent fee is where it's based on how much money. Okay, it gets a little bit unethical when you say to a client, I'll file this tax return and you give me a percentage of the amount I get back for you as a refund. Okay, so now you've got every incentive to cheat as much as possible, and that just doesn't seem to be a very good way. But it's not completely unheard of to charge a contingent fee in certain cases. Charge an unconscionable fee, too high amount, and no one knows what that means, but unreasonable delay. Okay, IRS asks for information and you say, can't get to it. That's going to cause problems. Don't handle the IRS checks for clients ever. Just stay away from that idea. Okay. Stay away from conflict of interests, things that would cause you to look like you can't be fair with the client, or making false or fraudulent statements, specifically and especially when you are talking to the IRS.